and they're basically printing more money. That basically increases the money supply.
The quantitative easing is really buying back all of these outstanding government bonds and then putting money into the economy so that there's more liquidity, that banks and businesses are able to actually get actual cash back so that they can start to have economic activity again, right? So let's kind of pivot and start to talk a little bit about what are governments doing about this pandemic. There's obviously a lot of economic impacts from the situation right now, transitioning to remote work and social physical distancing. A lot of businesses are seeing huge drops in revenue. We're going to go into a recession. There's no question about it. It's going to be a prolonged one. Trudeau said, this is a new normal until the vaccine gets developed. So we're looking at 12 to 18 months here in Canada for this physical distancing to continue. So as we're thinking about the economic impact of this pandemic, what are some of the things that governments are doing to alleviate the effects of the recession?
Two distinct ways how governments can get a handle on economy is one is through monetary policy, which is typically controlled by the central banks, and the other one is fiscal policy, which the government controls, the elected body controls, right? First, let's look at the monetary policy. The most obvious one that we are always looking in the news is interest rates, right? What that interest rate means, it's called the overnight lending rate that the central bank uses to supply money to the banks, and that it gets injected into the economy. By lowering the interest rate, that means the money is more readily available, and they're basically printing more money. That basically increases the money supply.
Right. So then the quantitative easing is really buying back all of these outstanding government bonds and then putting money into the economy so that there's more liquidity, that banks and businesses are able to actually get actual cash back so that they can start to have economic activity again, right? To complete transactions and to do business activities.
So the liquidity is the key thing, right? Like the banks need to have enough liquidity to keep the economy running. So the other one, like you said, is it's called a repurchase or a repo, where they buy back government or the treasury bonds and in turn inject money into the economy.
Okay, so one of the interesting things that we're seeing is that typically as interest rates go down, we also usually see mortgage rates go down in tandem. But something interesting happened this time. As the interest rate went down, we initially saw mortgage rates follow suit, but very quickly it went back up. So that's a very interesting observation, right?
Before we go deeper into the interest rate, we need to understand there are two distinct types of interest rates, right? Fixed rates and variable rates. Fixed rates are not dependent on the interest rates, but they move with bond yields, your 10-year and 30-year treasury bonds. Variable rates, on the other hand, are directly dependent on the overnight lending rate. And the way that works is the banks add a premium to that overnight lending rate. The rate that consumers can get their mortgages is called the prime rate. So currently the prime rate in Canada is at 2.45%, and the overnight lending rate is at 0.25%. What the banks are doing is they are adding a risk premium on top of the prime rate because of the underlying systematic risk, right? The banks see that there is so much uncertainty in the market, in the economy, so they want to hedge their downside, and that's why they are bumping up their risk premium. And that's the reason why people who are trying to get new mortgages are not seeing the benefits of lower interest rates reflected in their mortgage rates.
Right. So then for someone who actually gets a mortgage, what we're saying is that there's several factors that go into their final mortgage rate, right? First, the overnight lending rate is only one factor that goes into it. And then the bank adds premium to ensure that first of all they profit from the agreement, and secondly as a way to make up for the risk that's inherent in the pandemic situation. And then finally, also they make an individual adjustment to kind of your own credit rating and your own ability to pay, where you're working as well, and what your job is, and how likely they think that you're going to continue working and continue to have that income.
If you're of high credit worthiness, right, you may get a better discount, but if your credit is not so good, you may not get that discount, or you might be even higher than the prime rate.
All this talk about the interest rates being cut, and possibly even going down into negative interest rates. There is a problem, right? When you're pumping in all of this money, right, to buy back all these government bonds, and then putting that money into the economy, and kind of economics 101, if you put more money into the system, that's going to lead to inflation, right?
Actually, there's a very big risk that it might even cause hyperinflation, like that's happening in Cuba and Venezuela and countries like that. That's a serious risk, right? However, there's also, because of this pandemic is such a global scale, there is a coordinated effort between all the central banks to properly control the money supply, right? So yes, inflation can go up, but the banks are working together to keep those inflationary pressures lower.
So, like, I guess we can think of it as a rising tide lifts all boats, right? So if all the currencies are kind of inflating at the same time, then they're kind of going to balance each other and stay at around the same level. And then
they're just printing money, and when they all are printing money, so that's the value they set.
And one of the interesting things about the U.S. Currency in particular is that it's the reserve currency for the world. And most of the currencies are benchmarked against it, right? The trust in the U.S. currency is still very strong, and it will continue to kind of enjoy the same value even as they continue to do these quantitative easing practices of putting money into the economy.
One of the key reasons why what the Federal Reserve does is, during times like this, they actively control the money supply internationally by buying and selling US dollars too. So they help maintain to keep off those inflationary pressures, at least across OECD countries and even some developing countries.
Right. It's unlikely that we'll see hyperinflation, but as we kind of see the money flowing from the governments to the economy, that it's something that we should be looking at to see if there are inflationary pressures.